Mr. Sohail Zubari, you're the Chief Executive Officer of Dar Al Sharia based in Dubai. How do you think Islamic real estate financing is different to the conventional mortgage lending?
Islamic home financing is certainly different than conventional mortgage lending. First of all, there is a misnomer. People talk about Islamic mortgage lender. So let me clarify. There's no such thing as Islamic mortgage lender because there's no lending in Sharia and there's no mortgage. There's no lending simply because when you go to a conventional bank, you ask for a property loan and they basically put the amount into your account because they are lending you the money to go and buy the property, which will be then mortgaged to the bank. So the property will be in your name, mortgaged to the bank. So that's why it is called mortgage lending. When it comes to Islamic home financing, there's no mortgage, there's no lending. What happens here is that if you approach an Islamic financial institution, they would actually purchase the property in their own name. It will not be in your name. It will be in their name, and they will purchase it from the seller, developer or any third-party seller, and then they will lease it to you. So what's happening here is that the title is being held by the Islamic finance company. So there is no need for any mortgage. So this is cost effective because there's no mortgage cost involved here because Islamic finance company will be buying the property in its own name and then leasing it to you for a period of 10 years or 15 years, during which you will pay the rent, which will basically cover the bank's cost in purchasing the property, plus the bank's return on the investment. And once the period is over and you have paid fully for the next 10 to 15 years, the bank will have received its investment and the return on the property, and then the bank will sell that property to you at a nominal price or gift it to you.
Okay.
In this case, there will be a separate sale and purchase agreement signed with the nominal sale price, and the title will come to you from the bank at that time, not now. So long as the bank is continuing to lease it to you, the title will remain with the bank and you will be the lessee or the tenant. So this is how it is different. There are different structures in Sharia, how to do a home financing. One is the murabaha, which is very much talked about, and this is actually a sale contract in which the bank is purchasing the property from a developer or a seller and selling it to you on a murabaha basis, whereby the sale price will be agreed today on the day of the murabaha transaction, the bank's cost and the bank's profit, and the payment terms will be 5 years or 10 years or whatever. But in this case, the title will not be with the bank, it will come to you because you are purchasing it from the bank. And in any sale and purchase contract, always the title goes away from the seller to the buyer. But one thing which will basically differentiate between the leasing and the murabaha is that although the title has been passed from the bank to you because you are the purchaser, but because there is a debt to be settled, so the bank will actually ask you to mortgage the title to the bank till such time that you have paid the bank the murabaha price.
Okay.
So this is where the mortgage will come only in this context. But majority of the home financing was done in the UAE and also the other Gulf countries based on leasing, which is ijara. And the banks held the title and then leased it to the customer. Now how it is different when it comes to the risk. You know that if you are holding a title, you are definitely exposed to the title risk, the ownership risks, which is not the case in Islamic financing. In Islamic financing, the title is not held with you. So if there is a partial loss or if it is a total loss, then definitely the Islamic bank, being the holder of the title, will be exposed to such loss. For example.
So in the context of the recession, for example,
Yes.
do you think people who took Islamic home financing will be better off than the ones who took the conventional method?
To some extent, what I have analyzed is that people who took Islamic financing were certainly better off. First of all, when you do the Islamic home financing, your amortization is straightforward. There's no compounding element also. You know on day one how your amount will be amortized. So it will not keep on going up like in conventional. Every 3 months or 4 months, the interest is getting added to the principal and then they are charging the interest on the new principal perhaps. Okay. Now here basically there is a straightforward amortization. If there is a delay on your part to make the payment to the bank, the lease rentals, as per Sharia guidance, the bank will be basically negotiating with you and rescheduling the whole ijara for perhaps another 3 to 4 years to make it easy for you to continue to pay the rent. If, for example, you are unfortunately become jobless, then there are some insurances. Takaful, which is the Islamic insurance, which will cover during this period. The main thing which I have observed in the Islamic home financing compared to the conventional is that as per Sharia, the Quranic teachings are if a debtor cannot pay you the debt, then you give him more time. So here the Sharia board will basically guide the bank how to reschedule and how to give more time to the client to be able to pay back in a larger period or longer period than what was originally perceived.
Okay, and just finally, how can commercial real estate such as offices and shops be financed Islamically?
Typically in the UAE and especially in the Gulf, I have seen that majority of the home financing companies like Tamweel and Amlak, which had about 60% of the market share, plus DIB and the other Islamic banks, prefer to do this financing for residential units. Very few banks went out to do the commercial financing. Commercial financing can be done also by the banks through the SME, the small and medium entrepreneur in that category, whereby the bank may become the partner with the client by purchasing the shop, for example, and contributing the shop under the musharaka or the JV to the client. Now what will happen is that the client will be contributing equity to build up the business, the bank will be contributing the space, and then they will enter into a musharaka or the JV, and gradually the client will buy the bank's share in the JV on an agreed basis. For example, in 5 years' time, on a monthly basis or quarterly basis, the client is paying an amount to buy the share of the bank in that musharaka or JV on a gradual basis. So this is one way which could be done. It could also be done under murabaha, that the bank will purchase the commercial property and then sell it to the client on day one. Title will go to the client, but mortgage, and the proceeds or the revenue generated from the outlet can be siphoned off to pay the murabaha price. There can be some other exciting structures to do that.
Okay.